Are you considering a lifetime mortgage? Let's look at how this mortgage option can unlock your home equity, help you plan for retirement, and even ensure that you continue to receive means-tested benefits. What is equity release and how does it work? Before we delve into drawdown lifetime mortgages, let's quickly understand equity release. Equity release allows senior homeowners to borrow against their home equity without making monthly repayments. Instead, they receive a tax-free cash lump sum. The debt is repaid only after their passing or when they move into residential care, using the proceeds from the sale of their property. Who qualifies for equity release in the UK? To qualify for equity release in the UK, you need to be at least 55 years old, although some specific lenders may have their own specific age requirements. The property you wish to release equity from must be your primary residence and meet the lender's minimum value criteria. It should not have any outstanding debts, including residential mortgages. The difference between a lifetime mortgage and equity release. Now let's clarify the difference between a lifetime mortgage and equity release. While equity release encompasses two types of loans, a lifetime mortgage is one of them. A lifetime mortgage refers to a loan where you receive a lump sum and are charged interest, which accumulates over time. It falls under the umbrella of equity release. However, not all equity release loans are lifetime mortgages. Some can be home reversion plans. Lifetime mortgages explained. Let's explore lifetime mortgages in more detail. A standard lifetime mortgage, also known as a lump sum lifetime mortgage, provides a fixed interest rate loan to the homeowner. No monthly interest repayments are required. Instead, the interest accumulates along with the loan amount. The total debt, including the capital and accrued interest, is repaid in a single payment when the homeowner moves into long-term care or passes away. The different types of lifetime mortgages. There are variations within the lump sum lifetime mortgage category. The enhanced lifetime mortgage allows individuals with poor health to access more of their home equity. The flexible lifetime mortgage enables homeowners to make voluntary interest repayments, preventing their debt from growing excessively over time. So what's the drawdown lifetime mortgage? This variation offers homeowners a drawdown facility, meaning they receive an initial lump sum and retain the rest of their loan as a cash reserve. They can access additional funds from this reserve whenever needed. How do drawdown lifetime mortgages work? With a drawdown lifetime mortgage, homeowners can take an initial smaller lump sum and keep the remaining loan amount as a cash reserve. The reserve stays with the lender until they request further funds, which can be transferred to their bank account within a few weeks. The money in the cash reserve doesn't accrue interest until it's accessed by the homeowner. Drawdown lifetime mortgages example. Let's consider Janet and Barry's situation. They decide to take out a drawdown lifetime mortgage of £40,000 to renovate their home. They estimate that they'll only need £25,000 initially. As they near the end of their renovations, they realise they require an additional £5,000. Fortunately, their lender still has £15,000 in their cash reserve. They request the extra funds and complete their project without having to pay interest on the remaining £10,000 in the reserve. Drawdown lifetime mortgage interest rates. Drawdown lifetime mortgages have a different interest charging structure compared to standard lifetime mortgages. The initial smaller loan amount is subject to a fixed interest rate, similar to other lifetime mortgages. However, if homeowners decide to access the remaining loan funds, the additional amount may be charged at a different interest rate based on the current market rate. Why choose a drawdown lifetime mortgage? Why would you choose a drawdown lifetime mortgage over a lump sum option? One key advantage is the ability to avoid over-borrowing unnecessarily. By taking out what you need initially and keeping the rest as a cash reserve, you prevent paying interest on unused funds. This helps you manage your finances better and avoid unnecessary debt growth. Does equity release affect your pension? Equity release does not affect the basic state pension. However, it can impact means-tested benefits, such as universal credit or pension credits, which evaluate your wealth to determine your eligibility. Can I pay off a lifetime mortgage? While it's usually possible to pay off your equity release loan, doing so may incur early repayment charges. These charges are a percentage of the remaining loan, making early repayment quite expensive in many cases. What is the Equity Release Council? The Equity Release Council is a group that invites lenders to join and adhere to its rules. These rules aim to protect homeowners and provide additional guarantees. One significant rule is the negative equity guarantee, which ensures that lenders cannot pursue unpaid debts beyond the sale proceeds of the property. Look for the Equity Release Council's logo on lenders' websites to identify members authorized and regulated by the Financial Conduct Authority. If you're interested in seeing if you could release equity, then simply click the link in the description below and fill out the short form. It contains a few questions like your property value and your date of birth, and it will give you access to quotes tailored to your circumstance. It's totally free to fill out, and of course it won't affect your credit score. So click the link in the description below and fill out the short form to try it out.